Hello and welcome to this edition of Markets Unwrapped with me, Craig Melling, Director of Investment, and Rob Harrison, the Head of Systematic and ESG. Today we're going to delve into what happened to markets in May, but as we approach that halfway point of the year, we're actually going to start to look beyond where we are now and some of the implications of what we've seen throughout 2025 and the beginning of 2026. So May was a good month for risk assets. Although it was fairly turbulent, we saw lots of positive returns, in particular in the AI enthusiasm and the stocks that are covered by that particular trend. Bonds were particularly troubled. But Rob, let's talk about fixed interest before we delve into equity markets, because equity markets were really positive, but bonds told us a completely different story.
It was a really interesting month for bonds. So at the start of the month, we saw bond yields rise. There was more concern around inflation globally, going back to the Strait of Hormuz and the oil prices. So we saw this big rise in bond markets. But we did see the second half of the month, especially the last week, bond yields come down as we saw more chance of a peace deal and oil coming back onto the market. Yields ended up roughly 10 basis points ahead of where they started. But it was a very volatile month. We also saw more volatility in the UK gilt market because, as well as the global uncertainty, we had UK political uncertainty, which meant people didn't want UK bonds at the start of the month, but some of this came to tuition throughout the month.
Without going too much in depth UK politics, kind of what's the gilt market telling us right now? What's it telling us about Starmer leadership and how have they behaved over the last couple of weeks?
So if I go back to the start of May, there was more concern about Keir Starmer losing the job, not being Prime Minister, and someone else from Labour coming in as Prime Minister. This creates a lot of uncertainty. It all comes down to what their economic policy is, what their fiscal and monetary policy might be. So we have Andy Burnham, who's sort of the lead candidate for this, that might be able to come into Parliament and challenge Keir Starmer later on this year. At the start, his policy was very pro-spending and not cutting back any public spending. So as a result, the UK would end up with a bit more debt, our spending would go up, and there's concerns around what tax receipts would come in. This wouldn't be good for gilt markets. But what we saw throughout the month is, as his leadership campaign sort of came to fruition and started coming through, he was more friendly towards markets. He had more chats with people in the city, banks, major institutions, try to reassure markets that he would be very fiscally aware of what his policy was. And as we saw that, yields then started to come back down.
So the UK is almost isolated a little bit, and what we're seeing in bonds has that impact from inflation, the conflicts, and the things we've talked about at the beginning. But there's that extra added factor of the UK political landscape, which I feel like we've been here before. When we look at equities and bonds as a whole, the market's almost looked through the conflict in terms of equities. It's looked at earnings, it's looked at corporate results, and how strong some of these companies have been. And we saw a particularly strong earnings season in May, which helped drive markets to all-time highs. If we take the flip side of that and we look at the bond market, it's really focused on inflation, the knock-on effects of what we're seeing with the conflicts. The market's almost kind of watching the oil price intensely to kind of, if it goes up, we see a wobble in the market. If it comes down, we see positivity. Just coming to the conflict, where are we today? It's the 8th of June. Where are we today? 'Cause it's not in the news as much as it has been, and it's not been as prominent, but it's still rumbling on, isn't it?
It's certainly rumbling on. As of today, we're still within the ceasefire. The ceasefire has been extended from the initial one, which is why markets have been more positive. There are talks going on between Iran and the US. Noises from both camps seem to be positive that they can come to some sort of deal or conclusion, which means the strait can open and oil can then flow back out to the rest of the world. We have seen tensions come up again this morning. We saw Israel and Iran exchanging fire, which they haven't done for a few weeks. But we expect it to be quite a volatile situation until a deal's in place. But even post a deal being in place, there'll most likely be some spike ups and things that go on.
And a word we use a lot and we talk about a lot is resilience. And I think the market's shown resilience, but that's because it's probably looking through the conflict, as we say. Earnings have been resilient, and I think that's probably something we want to focus on for the remaining part of the year, isn't it? It's going to be, can markets continue to be resilient? A couple of things we are worried about, and some of the things that we keep challenging ourselves with as an investment team is, what does that inflationary backdrop look like? How does that have an impact on equities and on bonds and other asset classes? But also kind of, what tone does that set for central banks? And there's a lot of noise around central banks and central bank policy now. Are interest rates moving higher? Interest rates are going lower. Let's just kind of set the scene of what happens in those scenarios throughout the rest of the 2026.
Yeah, that's a great question and a great point. Everything's really coming back to inflation. So if we go back to what's causing most of the volatility, take away some of the political parts for the UK, it's really, is inflation coming back? Is it going to be sticky? And if it is sticky and inflation comes through because of oil prices or in the US because of consumer demand, then interest rates will stay higher for longer or potentially even go even higher. When we look at value in equities, we do this on usually discounted cash flows, which is what's the future value of this money, which is linked to interest rates. So everything sort of value in the world is based on what interest rates are. But on top of that, there is also government borrowing, which is at an all-time high. So they're paying more interest, which means they've got less to spend on schools and hospitals and government spending. We also see companies, not all, but some companies are quite indebted, so they pay more interest. And as well with the consumer, if you've got mortgages, loans, again, the cost of servicing that's higher. So this is why it matters so much. But there's a lot going on in the world where we could see higher inflation for longer, or we could see it come back down, or we could see something in the middle. So it's very hard at this moment to know exactly how inflation goes without knowing what happens with Iran and the Strait of Hormuz.
So we touched on equity markets were extremely positive in May, and let's circle that back and kind of, before we go into what did well, let's talk about why they did well. And I think you've just touched on it there. I think we've seen a very cautious tone from central banks, which has been seen as a positive. Lots of economic data, which we've seen over the last month or so, has not been as bad as some people potentially had anticipated. So that was supportive of risk assets like equities. And then we've got the AI euphoria. All those things have been positive, haven't they, in May? And just explain the shape of what did well in the month.
So the big one that did well was the AI euphoria. So we've seen this happen a few years ago, and we keep seeing different periods where everyone gets excited about AI for lots of different reasons. It can be a breakthrough, it can be people seeing earnings come through. But this month we saw it interesting, not just in the hyperscalers, so not just in the Microsofts and Amazons and Googles who are building all the data centers and driving it, but we've seen it in the chip makers. We've seen it all the way down the supply chain as people think this could be a much longer, prolonged sort of investment cycle. So for that reason, we've seen Asian markets do really well with the likes of Samsung and TSMC and chip makers in Asia. We've seen the US markets do well with the hyperscalers, but also the likes of Nvidia. So we've seen all these parts of AI do very well because we've started to see more use cases come through, and people will be able to think we can monetize this and it'll increase company profits, because that's what we're in the equity markets for, is it's the end company profits over time.
And come back to that word again. I think when we talk about resilience, a big focus for the remainder of the year is going to be the resilience around AI infrastructure, AI earnings. These companies, as they come and talk to markets about where they are, what they've been doing, people are going to be looking for positivity, resilience, and see how they can deliver going forward. And I feel, there is an appetite for risk assets, and there's going to be no bigger barometer than what we're going to see on Friday, potentially the world's largest IPO of SpaceX. And I think that will give us a direction of what appetite investors have got for equities right now, for risk assets. It's going to be a really interesting case, isn't it?
Oh, it's going to be fascinating because we've not just got SpaceX, we've also got Anthropic and OpenAI looking to IPO this month or next month as well. and the IPO market sort of coming back to life with more companies coming along. So to do something at the size of SpaceX is going to be really interesting of how it gets away and how positive or negative it's going to be.
I'm sure it's one we're probably going to be talking about in the next edition of Markets Unwrapped. Um, so before we finish up, Rob, let's just think about the rest of 2026. We've got some big events. So we've got some big IPOs. I think they're going to be really interesting. We've got midterm elections. We're moving into the summer, which potentially could be a little bit quieter, but I'm not sure we believe it will be. I think as we sit here today, we think, the tail of the tape is probably going to be volatility, uncertainty, as there's just so much going on right now. But where and what kind of themes are we talking about as a team, and anything you want to particularly highlight that us as investors are going to be focused on for the rest of 2026?
I think it's a really great point. There's so many different events, which some of them have quite big binary outcomes. So it's looking through that and looking through the noise to go, what we're really looking at here. And company earnings are key. That's what we're wanting to see through across everything. Is inflation affecting company earnings? Is high debt levels going to affect company earnings? So it really, to me, comes down to focusing on company earnings, but also what does the interest rate backdrop do? Because that'll have the effect on bond markets and potentially on the consumer as well.
I think there's a really interesting backdrop here, and I think there's always something going on in markets. There's always something for you and I to worry about for the headlines. But I think we're at a really interesting case in point now where we're seeing the bond market say one thing, equity markets say another. And I think, you know, for the viewers, the rest of 2026 could be really interesting. I think, we want to help guide people through that. So as the market develops or as the narrative develops, it'll be something we continue to speak about. Right now, it is quite benign, isn't it? And we're in a bit of a watching brief and a wait and see policy. So in terms of portfolios, there's not much going on. It's kind of check and check again, isn't it, Rob? And for us, we're looking at different scenarios that might play out in terms of inflation, really, for the rest of 2026. So, Rob, final question of today, and the one we're all thinking about. As we approach the biggest sporting event in history, I suppose the only real question is it coming home?
That's the hardest question you've asked me today. Like markets, it's probably going to be very volatile. There's going to be lots of ups and downs, and it's a wait and see policy.
Good answer. So, thank you very much for joining. Hopefully, we've answered a lot of questions around the Markets Unwrapped and what's happened in May and some of the things we are looking at moving forward. Um, Tune in the next edition of Markets Unwrapped to see what's happened in June.